I'm 92.90, 10 by 10. Yours.
Mine.
99 at the buck. Welcome to the Open Yield Markets Podcast with your host, Mark Hebert.
Welcome, everybody, to the latest episode of Open Yield Markets with Mark podcast. This is our, I believe, 8th episode in this journey on the podcast effort. We're really happy today to have Nick Gendron, the global head of fixed income index product at Bloomberg, with us today. He is a pioneer in index product. In fact, he's been doing index product at Barclays and Lehman before. And if you are a institutional investor or trader or salesperson, you'll know that Barclays and Lehman are the forefront of indexing in general for fixed income. So he's been doing fixed income indexing basically as long as Dow Jones has been going on in the equity market. We couldn't be happier to have him on the podcast today to talk about what he does, what's on the forefront for fixed income product in general, a little bit about electronification and automation of fixed income, and some exciting news from Bloomberg and a new product launch they have their end. So, Nick, thank you for joining us. We are very happy that you can make it to Conference Room Double Z. One day when we grow a little bit, we're going to have our own studio just like you guys at Bloomberg. But for now, we have this beautiful backdrop and the nice open air. So thanks for being here.
Wonderful to be here, Mark. Thank you for having me, and looking forward to the podcast today.
I appreciate that.
Yeah.
So let's kick it off. You've been in indexing your whole life. You started at Lehman, Barclays, Bloomberg, maybe some stints in between, but those are the real meat potatoes.
That's really it, honestly. 3 firms.
3 firms, which, a loyal guy. He was very loyal when I asked him to do this, and we appreciate that. Talk to me a little bit about where you were at Lehman, into Barclays, into now, how index product and fixed income has started, evolved a little bit, and where you kind of see it now and in the relative future.
Yeah, sure. I mean, look, when I started at Lehman, more than 30 years ago, I think Lehman was just really starting to discover how important bond indices were to investors. They really started just creating what was called an index support group, which they flagged me to come over and try to help them out. I hardly knew anything about a bond back then, believe it or not. So they took a flyer on me, and I was happy that worked out. But honestly, the foundational concept of an index, I then still holds true today. What you really, but has evolved in many ways too. So I'll get to that in a second. But when you look at the purpose of an index, you are really trying to provide an unbiased view, market neutral view of any specific market. That applies to equities, commodities. We'll talk about fixed income. And certainly the ag was the index of choice back then in the 90s, still is today. But again, you need to make sure that your index is all the buzzwords, representative of the market. It's transparent as far as how you're pricing it, and it's investable. If you have all those things, you're representing the market as accurately as possible, and then clients can choose that as their performance benchmark. They're very certain of the accuracy of it, and their goals against that benchmark, whether it's passive management or active management, will come to fruition based on the fact that they know that is an accurate representation of the market. So that foundational concept of indices will ring through forever as far as what does the market look like? How is it performing? You build on that, though. Like for us, it was all about investment grade bonds to start, and it grew into pretty much the fixed income market is extremely diverse. High yield, emerging markets, municipals, inflation linked bonds when those were issued in the 90s. Our global aggregate index, 28 currencies now across the global markets, into many other types of products. So we've tried to keep pace with the evolution of the market, with the growth of the market. And so as far as trends or how indices have grown, certainly in scope, but I would say the ETF market is really what changed the use of indices. You could still use them as a representation of a market, and the biggest ETF products are based on some of the most standard indices out there, our ag, our corporate index, our global aggregate index, et cetera. But today's ETFs are, if they're actively managed, then they're just pursuing outperformance to a relative to a standard index. But as far as indexing in the ETF market, it's really more about strategically based indices, alternative beta. How am I going to get an exposure that outperforms a specific market? And there's plenty of examples. I'll give you one: enhanced yield index. You take our US aggregate index, you reweight the components to achieve a yield beyond the ag, but try not to stray too far away from the ag. So you're trying to outperform in a very systematic way so you can index it. You're not actively managing, but you're wrapping up a strategy into an index. And those things, that is really how the market is evolving in conversations with ETF providers.
Fantastic. So just for everybody listening on Spotify or on YouTube TV, if you want to see our pretty faces, or on Applecast, the ag that Nick is referring to as an investment grade trader for so long was kind of the, if Fibonacci is the Bible of fixed income, then the ag was the Bible of index traders and indices, and how real money managers and people would follow the investment grade index. Nowadays, some firms have their own. JP Morgan has the Julie index, but still largely the ag, the Barclays ag, and such is still used as the standard, if you will, of investment grade index. So that's pretty fantastic. One thing I thought you said there that really stuck out to me, honestly, was just transparency.
Yeah.
Right. You said representative, transparent. When you guys are constructing new indices, and we'll get into a little bit about some new things on the horizon soon, when you're working with your team, I'm going to guess that those words are used in every meeting. How do you deliver on those? How do you make sure that these indices, because they need to be reliable for investors to be using them, are representative and transparent?
Yep. It comes down to really how you set indices up. You know, if you take any of our broad-based indices, whether it's the ag or a corporate index, there's thousands of bonds in these indices. So you start at the bond level. You're pricing every bond. You're calculating a return for every bond. You're calculating a duration, a spread, key rate, duration, exposure, yields, et cetera, for every bond in the index. And you're actually making that available. If you go onto the Bloomberg terminal, you can actually type in any of our thousands of indices that we publish, get the membership, see the prices, see the returns, and see the market value weights and how that rolls up into the broad index. So transparency is like our mission: provide transparency of the bond market to basically to the marketplace. And you do that by, every single security you have to start with, and then you have to provide the relevant measures and the tools that they can look at those thousands of bonds and break them down into aggregations that make sense for them. Clients aren't looking at their portfolios against a bond index and seeing what their weighting differences is at a bond by bond level. They're looking at sector distributions across the curve. What are my weightings? What is my duration exposure? You need to provide all those metrics, and that's really the key. To make sure that you're providing that relevant information, the distribution channels you're using, like the terminal, like even other vendors who will take on your data and make it available to the marketplace. So that's a really critical element.
And as we know, reliable, transparent data is really king. It's what people really sought after, so they can make their own investment decisions with good, reliable data.
Yep.
So there's a buzzword if you're a fixed income investor, especially a bond trader with the Bloomberg world, and that's BVAL.
Yes.
Right? BVAL has been, what started out as, what is this BVAL? Now every trader on Wall Street says, this is how I trade bonds. I trade bonds BVAL plus, I trade BVAL minus. It's like the gold standard and Nike of branding amongst pricing metrics. When this was first created, was the end goal to be where it's being now, where people are literally talking about it as a quote methodology? I talked to a trader a few weeks ago. They have in their internal system an ability to change their markets versus BVAL. So as BVAL changes, their markets change, or they can tweak their markets one way or the other versus BVAL.
Yep.
A couple questions is on illiquid securities versus liquid securities. Liquid securities, I feel like BVAL's accuracy has got to be pretty spot on.
Absolutely.
How do you, in general, use BVAL or determine some sort of reliable pricing for illiquid prices for something like BVAL on not just investment grade securities, but down the credit spectrum?
Sure. And it's sort of, maybe it makes sense to take a quick step back. How did the pricing of our indices evolve back at Lehman and Barclays? They were trader priced indices for the most part. There's small exceptions, but if our desk priced or transacted in a certain sector, they would be the ones that provided the prices.
So if I may real quick,
Yeah.
you're saying that this was traders' marks would create the beginnings of a BVAL or an index or pricing service, excuse me.
In some ways, yeah, absolutely. The traders and we'll get there in a second, but I think, and clients trusted those indices because they were trader priced, right? And the problem is traders are trying to do their day jobs and, price the index at the same time. And that was always a difficult balance. But when our business at Barclays was bought by Bloomberg, the one thing that I think was a real improvement to our process overall and to the transparency and to the processing efficiency of this is that all the pricing moved over to BVAL. So because BVAL covered all the markets. Now, were some clients nervous about moving from trader pricing into a vendor type pricing?
100%. I know I was.
Certainly they were, but I think clients saw very quickly that BVAL had accurate pricing. Was the interesting thing to me about BVAL as far as their pricing is concerned is you could bring up any bond and type in BVAL and you'll be able to see exactly how they arrived at that price. They'll even score the price for how strongly they feel about the level, whether it was based on direct observations or whether it was based on maybe some contributions that came in from dealers, or whether it was model price, or whether it was a kind of a combination. But they tell you exactly how they arrived at that price. I mean, look, they're not exchange traded, so they're not as, they're not as, like we've used the word transparent as you'd like them to be. But BVAL does the great job in allowing you to see exactly how they arrived at that price. And it allows clients more comfort. They always are available to have a challenge on a price and explain how they got to it. But with BVAL now covering the extent of the markets that they cover, we can then launch products like we just did for loans. BVAL got to a stage where they were very comfortable with their pricing process that allowed us to create an index on it, and we keep moving along. So that's our partnership with BVAL is critical to the success of our index business.
Speaking of moving along, so I'm guessing that BVAL's proliferation has helped what we're about to talk about. And that's the launch of something novel and new for Bloomberg and your team, which is pretty exciting. And to be fair, I did a little bit of work with you on what this actually was, and I was pretty excited about it. I'm excited to speak about it. So you guys are going to launch the Bloomberg U.S. Total Fixed Income Market Index. You want to speak a little bit more about that? I don't want to take the thunder here, but it's pretty interesting. You're taking the market that is fixed income and rolling it into an index, more or less. Is that
into a whole index? And I think it's important to take a step back and say, okay, you've got a total market index, you have the ag, how do they interplay with each other? What's the real driver behind it, which is really what you asked. So you already mentioned the ag investment grade. That is sometimes when I get questions, whether it's from the press, not from really a market participant, but the education is that the ag is designed to be core investment grade, fixed rate part of the market. That is by far the largest part of the market. If you look at the ag, 14,000 securities, 32 trillion in market cap. That's huge in itself, but the market is bigger than that. You need to venture into high yield. You need to venture into loans, maybe structured credit, some emerging markets, more private like 144A markets, that type of thing. But the goal is the ag is going to have its place as the fixed income, core investment grade index. So the driver behind this is really, first off, it's kind of interesting. It's more of an educational tool. What does the fixed income market look like in its entirety under one umbrella, right? Why didn't we do this before? We had an iteration called the U.S. Universal Index that put in some high yield and EM, but this breaks down pretty much every barrier as far as rules. So it's putting in leverage loans, which are floating rate. It's putting in other floating rate securities like investment grade corporates. We will be adding structured credit or broader structured credit, which is our big endeavor through sort of mid next year. So that will be added to this index. So an extension of our asset-backed and CMBS and non-agency RMBS coverage will go into here. They are a little more nuanced markets, so probably less liquid markets than the core investment grade.
That's probably why they haven't been
right.
Exactly.
They haven't been indexed well. There are indices out there. We feel like we can, get right in there and index them extremely well and couple them with everything else that we have as a product suite. I forgot about inflation-linked securities as well. So that's another piece of the puzzle. And really just bring people the market in its entirety, and allow another option for clients to evaluate. All these securities are part of active managers' portfolios, most of them core plus type portfolios, but they are part of their portfolios. And, overall, the total market index has about 50 basis points more yield than the ag. So, you're adding about 10 trillion in market value to the already 32 trillion of the ag. And again, it's in the components that I just mentioned across high yield and EM and loans and structured credit.
So the way I'm kind of rationalizing this, you think about this is, S&P 500, you can break it down to all these separate indices.
Yep.
You can get as granular as you like, and then you can roll it all the way back up.
Yep.
Sectors, etc. So you can actually do the same thing. U.S. fixed income total market, I can then drop it down and say, okay, within that, what's moving today?
Yep.
What's it? The ag, the high yield. Yep. So you're going to have all these components, sectorized, granular, but then it's going to roll up into one index. So you can say, okay, let me just get a nice snapshot of what's going on.
Yep.
Fixed income today. Let me compare it to what's going on in equities or, currencies, etc.
Exactly right. I think it's really just it's really painting a picture, as I mentioned, of the market as it is. But again, it has to be investable, right? It can't be these nuanced like private markets is something we'll probably talk about in a second. But it's tough to index that. You just don't have the ability, even though that market is growing. So what can you get your arms around that you could truly invest in and represent in an index? And you can put this side by side with the ag and say, okay, when does it perform better than the ag? When does it perform worse? A lot of it might be just duration because it's about a half year or so shorter duration because the presence of floating rate securities. It's much better diversified, but it's got more credit risk. So all those things are trade-offs, but again, it's educational. Asset owners might look at this, say,
representative and transparent.
let me look at this. Okay, I've got my ag investment here. I could do something like this. Does this make sense? Or do they want to keep using building blocks? A lot of asset owners use, okay, here's investment grade, here's high yield, maybe some loans, maybe some private credit. They're using these in different sleeves. So at least give them the ability to bring it all together.
So I would imagine, and probably wager even as a betting man that I am, that once you launch this or in unison with launching this, you're going to have people who are going to want to create ETFs in partnership or not in lieu, in partnership with this.
Yes.
So is that something you guys are already fielding? Is that something that you anticipate? Or
There is, and it's public, so I could talk about it. But there is a filing out there in the market already. We'll just leave the issuer unnamed for now. But you can look it up. But it is something that you know an ETF product will be launched on the index. And look, does an ETF make it legitimate? Yes, in many ways. It like the especially it's a key ETF issuer, and they would like to show this in the menu of offerings, and I think it's a great idea, and I think that will just help put more eyes on it, and really to understand all the use cases. By the other thing I do want to point out is that by putting all those building blocks out there, clients now do have the ability to sort of say, okay, now I can customize around this too. I can work all the different components of this together. I could let's look at a total 1 to 5 year index. So I've got a shorter index, but it's the complete market. And so I want a shorter duration version of it. I mean, you could go on with the permutations, but it should be interesting to see how it evolves.
It's going to allow fixed income investors and traders to not only track to the market.
Yep.
Right now, you go, all right, well, IG's 4 wider and stocks are off 0.5%. I can reason with that. Now it's going to be IG's 4 wider. The overall fixed income market's largely unchanged. Maybe we're underperforming for a certain reason. Yada, yada, yada.
Yep.
Pretty compelling.
Yeah.
Well, that's an exciting launch. We're excited to see it proliferate. I'm excited when it does come out, which will be very soon.
Yeah, and it is just the U.S. for now, but I could definitely envision this, on a more global scale at some stage. Some of the markets just aren't, like loans much smaller in Europe, or securitized much smaller in Europe, so you don't have quite the breadth,
Right,
if you will. But certainly on a global scale, we already have many global indices, but it could work. We're starting with the U.S. and sort of working our way from there.
That's fantastic.
Yeah.
Okay, let's pivot just a little bit. There's the elephant in the room that everybody likes to talk about: private credit.
Yeah.
Here we are talking to a career, lifelong index product, creator, manager, overseer. How do you see, and what are your thoughts about how private credit evolves? And from an index perspective, how do you capture that?
Yeah.
How do you get involved with that?
I have to say, from an index provider standpoint, there's a bit of frustration because there's so much going on in the private markets, and yet can you put a relevant index out there? And we really want to do that as quickly as possible. That could be used. But even if you do put an index out there, that's some measure of the market. Is it really investable? Like, say we have, 1,000 securities in it. Could anybody even go out and purchase those? Unlikely. The secondary market in privates is definitely challenged. But there's a lot of conversation about the convergence of private and public debt, and when issuers decide to go the private route and when they decide to go the public route. So I do think you'll continue to see the convergence. I think you will continue to see better transparency in secondary markets, evolve for that. And then it becomes a definition of what is a private credit security. Is it just one that didn't come to market through a syndicate process, or is it just an issuer that doesn't have a public equity, or what's the definition of it? And I think people are trying to define that as well. But our efforts in this are going right along with Bloomberg's focus on this, which is significant, and trying to bring as much information about the private markets to the surface. We're as soon as our BVAL team, which they're working on a valuation model for private credit, our goal is to take all the securities we can determine from the BDCs who have to file their holdings on a quarterly basis.
Yep.
Take those and then put BVAL valuations on them, and sort of try to do a bottom-up look at the private credit markets. And then it's kind of, okay, once we have that, where can we kind of go with it? It's information that will be available to the market, and I think it's more informational at the outset and more research at the outset, and then as the liquidity of the market and the secondary trading potentially moves along, maybe they become investable or pieces of them become investable. But I think private credit indices they're going to have a long way to go, and but it's fun to be able to think about the puzzle and how we're gonna kind of solve it.
I have the solution for it.
Okay,
right? You just mark everything at par, because that's every private credit instrument is marked that. Every day there'll be no change in the index because there's been no change in the private credit markings, plus or minus, since they've started.
I've heard I've heard similar type of quips before, and I think yeah, because then you're basically saying, okay, here's what the market looks like, and here's the yield of the instruments, and they're just kind of accruing at their coupon rates, and there's no pricing change because nobody knows what they're actually worth. But hopefully the models that BVAL comes up with are a bit more sensitive to the underlying currents of the credit market. So we'll have to see.
If private credit becomes too public, they won't call it private credit anymore, too, and that will take away the acronym that everybody loves.
Look, there's always a chance with all the convergence going on. So
I always say, what could go wrong? That it's all marked at par. So my last question to you before a couple of quick hits is really about the future. And the one thing that I think has really been interesting from this conversation and getting to know you is really you guys balance stability and reliability. Like you said, transparent, representative, with also a need to stay important in the marketplace through innovation.
Yep.
How do you balance that need when you're working with your teams of saying, hey, guys, we need to keep on the forefront of technology, innovation, indices that maybe others might create if we don't do this, whatever, with staying representative, transparent, and showing stability?
Yeah, you've just laid out kind of if I bring up any slide about our business, it's got a few boxes, and it's got really three.
Yeah.
One is just new beta concept, loans, securitized credit, private credit. Where don't we have coverage? Maybe some emerging markets or frontier markets. Like, where do we want to put our resources there? Where can we show that we're continuing to invest in the foundation that we've built? And it's incredibly important. You can't just say, what's the shiny new thing? Let's go grab it and keep this. We already got this part done and let it just run in the background. Clients are looking for improvements, enhancements all the time. I'll give you a quick example of that. Clients want more transparency into the turnover of our indices, why bonds are falling out, why they're coming in. And not that you couldn't figure it out just by looking at them, but they want it summarized. They want the transaction costs part of it more transparent. They want the metrics delivered to them. They want to go on the Bloomberg terminal and have more flexibility in picking apart indices. They really want you to sort of invest in your platform. And it's a big thing for us. And then we have to innovate. We have to be able to go into ETF providers, not just, hey, what are you thinking? Like, we could build it for you. It's got to be us trying to not force the conversations, but really be at the forefront of the conversations with, what can we do? What have we been researching? What are some of the interesting concepts that might resonate with our ETF clients? It's really all three, and I know that's kind of a cop-out answer, but it really has to be.
It could have been 5. 3 is good.
It has to be split across those things, with obviously some good strategic thought. But there's a lot of things that we're working on to continue to improve our platform and the Bloomberg terminal delivery of our indices, including a custom index tool that we're looking to roll out in pretty near future. So that's something exciting as well.
Well, hopefully we can have you back to talk about that.
Yeah.
We appreciate that. Couple quick hits. Just I do this on every episode.
Sure.
It's for the audience just to get to know you a little bit more away from your day job. When you're not creating revolutionary index products, what's one of your favorite hobbies? What do you do?
I'm golfing.
Okay. What's the favorite course you've ever played?
Well,
And that's what your handicap is, but I don't want to show the audience
it's
here.
all right. My handicap's fine. It's kind of average, but for sure, the favorite course I've played is Pebble Beach. Brought my family there a couple of years ago. I have two sons who are grown up by now, but they play. My wife plays, so it's a great foursome. They have their wives now who also play, so we can get out there as a group and play. We all went to Pebble Beach. I played quite a few courses, but that's by far my favorite.
Can't go wrong with that.
Yeah.
Now,
Yep.
did you hit the green on the first shot on that par 3?
7th hole?
Yeah.
Trap.
Yeah.
I played it twice. Trap both times. Pulled it.
Well,
Too bad.
Could be worse.
My sons got on. I was not happy.
What's as you've traveled the world for work, I'd imagine, what's the favorite place you've ever had a pit stop?
Pit stop or destination or anywhere, anything. I would say, look, I've been to London so many times. I know that's a kind of it's not a like this elaborate answer, but I've been to London so many times. I love that city because I've been there probably over 50 times in my life. So I love every time I go to London. But outside of that, I would say Tokyo. I just we've got the culture there, the people there are fantastic. So I
We get along as well. Tokyo's on my top list too.
Wonderful.
What's the best book you've ever read?
Oh, best book. My wife will kill me because she always tells me I have to read more. So I would say
She actually asked me to ask you that.
yeah, I can't even steal one of her lines there. I would say it's Liar's Poker.
Yeah.
Just because it's a financial book and it's just really interesting. It's been a long time, but if I read books, it's more fictional thriller type stuff. Light.
So if you saddle up at a bar this evening, what's the first thing you're ordering on a drink of choice?
A lot of my friends and colleagues would be able to answer this very quickly. It's a Hendrix and tonic for me. It has to be Hendrix, has to be tonic, has to be a cucumber with it too. So that's by far my favorite.
There you go. I appreciate it. Hey, listen, Nick, thanks for your time.
Mark, thank you.
Hey, we have the U.S. Total Fixed Income Market Index rolling out. Please go to your terminals and get on there and check it out.
Yep.
And we really appreciate your time today.
Total FI will be the ticker, so it'll be great. Thank you so much for the conversation.
Absolutely. Thank you.
All right,
this is OpenYield Markets Podcast. We'll see you guys next month with a new guest.